Bring in show music, please.
This is Squawk Pod, and I'm CNBC producer Cameron Costa. On today's episode, uncertainty breeding market volatility.
We know what it looks like it means, and that's a sell America trade.
Goldman Sachs CEO David Solomon issues a word of caution about tariffs.
Until businesses and individuals all over the world, not just here in the United States, can understand our trade policy, how it's going to be implemented, and that allows people to step back and make decisions about their capital spending, their investment, their planning.
Solomon's watching U.S. treasuries and tariff plans, but he says you can't unwind 80 years of global investment in a snap. And markets, well, they tend to overreact.
This is a stressful time, but in terms of market function, this is in no way a crisis.
And Facebook co-founder and economist Chris Hughes is out with a new book, just as regulators are taking aim at Google and at the company he founded. Hughes is not opposed to reining in the giants.
I wrote the book because I believe that the private sector is very, very important to spurring innovation.
No, that's what
it just
the whole
needs
book
to
says.
be managed.
Those conversations plus AI at the Oscars, not off the table. And Harvard is suing the Trump administration.
That is where the free speech piece of this is complicated.
It's Tuesday, April 22nd, and Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody, and welcome to Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernen and Andrew Ross Sorkin. This morning, I'm in Houston at the Chevron Leadership Initiative's co-mission Champions of Women in Sport event. This is a gathering of business leaders ahead of the Chevron, which is the first major tournament of the LPGA Tour. This is a moment in women's sports where you're seeing lots of money going into it and lots of interest along with that. We'll be talking about all those things through the course of the morning. You saw the Dow off by close to 1,000 points yesterday, closed down by more than 900. It was the worst day for both the Dow and the S&P that we've seen since all the way back to just April 10th, so we are getting a little used to this volatility. NASDAQ futures this morning up by 167 and the S&P up by 46. All of this happening yesterday as President Trump ramped up his attacks on Fed Chair Jay Powell and Fed independence. In a morning post on Truth Social, President Trump called Powell Mr. Too Late and a major loser, and again called for Powell to lower interest rates. You've also got gold coming off its 23rd record settle of the year. It's now closing in on its inflation-adjusted all-time intraday high of about $3,589. This morning, it's up another 1.3% to $3,469. Gold hit that record level on an inflation-adjusted basis in early 1980. Yesterday, the dollar continued to weaken. It hit its lowest level in 3 years. And you're going to take a look this morning. It's a little higher, only up by about 16 cents. And then you've got Bitcoin, which yesterday was higher, and this morning looks like it is up another 1.4% to 88,522. Guys, these moves have been really interesting to see equities weaken, to see the dollar weaken, to see yields rise. At the same time, you've got gold hitting these all-time highs. There's a lot of people wondering what exactly this all means.
I think we're still wondering what this all means, except not
we know
not
what
great. We know not great things.
We know what it looks like it means, and that's a sell America trade, which is I don't know how long it lasts and how it gets reversed. Journal has a good piece today. Best thing to do is get a couple of trade deals done and move on and do the other things that you were planning all along, and hope that hope we can, I don't know, reset a little bit, because definitely a lot of these things are not being taken positively by the market. That's an understatement. Obviously,
he doesn't seem to be doing that at the moment, unfortunately. I mean, he seems to be doubling down.
Depends on who's in his ear. He could, you know how quickly he can change.
And we should also tell you Harvard suing the Trump administration following the White House freezing billions of dollars in grants that was earmarked for the school. The lawsuit accuses the administration of flouting the First Amendment and asks a federal judge to declare President Trump's freeze order unconstitutional. Harvard argues that the move was not related to anti-Semitism concerns that the administration has cited. That lawsuit, in part, says, make no mistake, Harvard rejects anti-Semitism and discrimination in all of its forms and is actively making structural reforms to eradicate anti-Semitism on campus. But rather than engage with Harvard regarding those ongoing efforts, the government announced a sweeping freeze of funding for medical, scientific, technological, and other research that has nothing at all to do with anti-Semitism. In a new statement, a White House spokesperson says taxpayer funds are a privilege and Harvard fails to meet the basic conditions required to access that privilege.
We should talk about this. The thing, and I don't know, Becky, how you feel about it, though, we've talked about the anti-Semitism piece of it for weeks on end. The truth is, if you look at what the government has said and what the president has said as it relates to Harvard, anti-Semitism is only a small part of it. What they're really trying to do is change the structure of Harvard and change who they hire, how they hire, what they do, and a lot of it has to do with ideological beliefs. And he has made it clear that it's actually in large part about ideological beliefs, about the professors that are being hired, the students that are being recruited, all of those things. That is where the free speech piece of this is complicated. That is where the free speech piece of this is complicated.
He's got about six things, at least 6 institutional entities in mind that he is not happy with and wants to disrupt, including media, including law firms.
Correct.
Including,
and I think, and we'll see what courts ultimately think, that perspective is not constitutional.
Not to say that I don't agree that the Ivy League and a lot of higher institutions have totally lost their way, and I don't like what's happening to
by the way, I'm not saying that they're perfect. I think they can be a lot better.
They're not just not perfect; they're hideous in terms of who's hired and the dogma that's institutionalized.
Once you're in, you can't get fired. Right.
Why do you think we have such problems with anti-Semitism? Because all these wacky, crazy stuff is institutionalized.
I agree with you,
and that's who you hire, and it's incestuous. And then the people that you hired 20 years ago that were like that are hiring more people that are like. So what do? You just let it continue, and
well, first of all, I think it's actually shifting.
But what you're doing by targeting, in particular, the science funding, the National Institutes of Health, the national science funding that comes through this, is potentially breaking down. Right, but by setting these things up that are completely unrelated, what it does do is threaten the innovative engine of this country. So many of the great developments have come through the funding that comes through these universities. And I can understand being upset with how things have gone, with how some of these universities are looking on the other side of things. But to do this and to put all of that at risk, by the way, a lot of these funds were set up from funds that were promised for last year. If it's not resolved by July, from people I talked to about some of these issues on the science side of things, it's going to create massive problems. You are going to lose all kinds of students and doctoral candidates and PhD work that's being done and some of the most innovative cycles that are coming through. And that is something that, again, you can look at this the same way you look at the trade war. Were there imbalances and things that need to be adjusted? Yes. Is there a better way to do it? Yes. Is there a way that might preserve these institutions and preserve the functions that are best about the United States to do this instead of breaking everything and saying we're going to shut this down now until we get our way with it? That is the harsh reality, and that is the fear is that you break things that can't be fixed easily by doing it this way.
The Academy Awards giving some new guidance on artificial intelligence in movies for top prizes. The Academy of Motion Picture Arts and Sciences saying the use of generative AI tools in movie making will neither help nor hurt the chances of an Oscar nomination. But it also tried to convey the message that the more that humans were involved in a film, the better. Officially, it said the Academy and each branch will judge the achievement, taking into account the degree to which a human was at the heart of the creative authorship when choosing which movie to award.
Which I imagine is going to be increasingly difficult to
even discern.
Mm-hmm.
Yeah. But that tells you the guidelines. I mean, and just that fear in Hollywood of the machines taking over. Not just Hollywood, I guess a lot of places wanting to make sure that there's still the human creativity, that they're still rewarding that. Joe, you move in these film circles. I can't imagine they'd be thrilled about the idea of having a whole lot of AI there.
I'm dragged into these circles.
You are.
I am. Yeah, and sometimes people are kind of pointing at me, and I don't look like. I've never had granola. I don't think. I don't have it all the time. It is a certain.
But you do wear Birkenstocks with your socks.
With socks, with dark colored. You've done that, you said, right? You still do that.
I wear Birks, not with socks.
But you don't wear socks. Okay. Yeah, you're right. And Becky, I don't know, like we were just saying, how do you discern? It's going to be more and more difficult to see.
But there will be buzz within the community. Like these are the people involved in the film industry are the ones voting for this, and there will be buzz about where they actually use people and where they wouldn't. And my guess would be is if the artist community, the creative community feels like they were cut out of the process, you're going to get snubbed.
Right.
The Federal Trade Commission is now suing Uber. The government claims that the ride-hailing company provided misleading information to users about the Uber One subscription service, failed to provide a simple way to cancel memberships, and charged people without their consent. The move is the first FTC action against a major tech company during President Trump's second term. Notably, Uber and CEO Dara Khosrowshahi each reportedly donated $1 million to the president's inaugural fund. And Uber spokesperson telling CNBC the company is disappointed by the FTC's complaint, but is confident the courts will rule in its favor, Joe. So I think for all those folks who thought that,
That's not why. They could be just patriotic and want to participate in the inauguration of the U.S. president. Stop being so cynical. I'm going to start drawing a line at some of this cynicism, okay? We've got to move on. We've got to come together.
Yeah.
We've been apart for, remember HW? Got to come together. Dana Carvey, we've been apart.
Let me just tell you, I spoke to so many CEOs who wrote those checks.
And they wanted something?
Who will privately tell you exactly what they think, which is that this was a down payment. And all I'm suggesting to you is it was a down payment on nothing.
Because, it was a down payment on the rug being pulled out collectively from under them? Good. These corporate fat cats.
Cheese will be next.
Next on Squawk Pod, Facebook co-founder and economist Chris Hughes joins us. He weighs in on President Trump's criticism of Fed Chairman Jay Powell, future of capitalism, and much, much more.
I also think that if Trump fires Powell, then the chaos in those markets is going to lift the cost of borrowing. It's going to make it a lot harder to follow up on those kinds of promises. So I think I'm American, I'm a patriot. I believe that it would be great to have those kinds of investments here at home. I just think that in the long term, it's a much better way to go about doing it.
This is Squawk Pod.
So you're watching Squawk Box right here on CNBC. I'm Andrew Sorkin, along with Joe Kernen and Becky Quick, who's in Houston this morning. Facebook co-founder and economist Chris Hughes out with a new book this morning. It's called Market Crafters, the 100-year struggle to shape the American economy. It explores the history of capitalism. And he joins us now. Got a whole bunch of things to talk to you about. But
I'm ready.
But maybe the best way to start is to try to put this moment in terms of our politics and maybe our economy in the context of what you looked at, because you talk about sort of the whole sweep of history. And, by the way, Democrats ruling and Republicans ruling.
Absolutely. So this book makes the case that there's a long history of policymakers organizing and managing markets for political goals, things like making Americans richer, safer, more economically stable. That's a joint project. Republicans do it, Democrats do it, and only by uncovering that hidden history are we going to figure out some way to rebuild after the chaos of Trump in this moment.
Okay, so here's my question. How important is, you went to Harvard, for example.
I did.
How important do you think government spending as it relates to universities, science endeavors, and things like that, compared to the quote-unquote true private market where there's no government money at all?
It's incredibly important. I mean, the universities are a major engine of research and development, and as you've seen over the past half century, the overall public investment in R&D has gone down, and a lot of that has shifted to the universities as being the engines of doing that. Now, for me, at least in the context of my research, what I find is even more powerful is when government institutions are doing that kind of R&D, making those kinds of investments for political goals. So something like the CHIPS Act from a few years ago, Republicans started in the first Trump administration. Republicans believed we needed to make semiconductors here. The Biden folks agreed. Congress passes it. Now we have 5 of the world's largest semiconductor fabricators either operating or opening plants here. That's a major investment of R&D, of course, but also of industrial policy to make us safer, and it's successful, and we can learn a lot from it.
There's been a lot of criticism about tariffs, but is there any example that, I mean, you talk a lot about more, I would say, carrots than sticks, if you will, but are there any examples where the stick has worked?
Well, I think on balance, the public investment industrial policy is a much better way to accomplish these goals. So bringing back jobs in American manufacturing, for instance. I think targeted tariffs can work in some moments, but I definitely don't think that's what's happening in this
administration. What do you make when we see a press
and
release like Roche announced this morning they're going to make a $50 billion investment in the U.S. They say it's going to create 12,000 jobs over the next 5 years. Right? We saw NVIDIA make a statement last week. We saw Apple make a statement 2 months. Is that policy by press release, or is that real?
No, I think it can be real. However, I also think that if Trump fires Powell, then the chaos in those markets is going to lift the cost of borrowing. It's going to make it a lot harder to follow up on those kinds of promises. So I think I'm American, I'm a patriot. I believe that it would be great to have those kinds of investments here at home. I just think that in the long term, it's a much better way to go about doing it.
One of the things I've been thinking about is assuming that Powell is out next May anyway. And assuming that Trump is going to put his person in then, why would the market dislike his firing, but be fine with whoever replaces him? Because you're going to think that because of what it says.
Because of what it said.
But the practical reality may be no different.
I don't think that's right. I think, a quarter of the book that I write about is the history of the Fed and why its insulation independence is so important to its success. And so, first off, the Federal Reserve Act is very clear. The chair cannot be fired unless it's for a cause. Now, the FTC Act also says that, and Trump has fired 2 of the Democratic commissioners. So we'll see if he follows the law in the first place. However, if he does fire the chair, he can also remove the other governors. So if he so chooses, if the courts uphold that way of thinking about it. And so all of a sudden you have a board of governors which is entirely dependent on the political cycle. And how are you going to trust that to guarantee price stability, let alone financial stability or full employment?
Chris, I just have almost my default position is that the government is probably the worst entity at you're snickering.
I'm not snickering. I just have a sense of what you're going to say.
It's the worst. No, it's just historically central planning and trying to allocate resources based on what 100 intellectuals in an administration think they should do. It just hasn't worked out in the past. And iPencil, Adam Smith, the invisible hand, that industrial policy, and I would say both sides probably make mistakes in terms of trying to orchestrate industrial policy. Solyndra on one side, and then the Republicans do tariffs on the other side with all the unintended consequences of tariffs. It just seems like central planning and industrial policy never works.
So I'm with you on central planning, but you like the Fed.
Is that different than industrial planning?
Well, what I'm talking about is something called market craft. And so I think the Fed is a good example here. I imagine you like it. Most investors, watchers of the show believe that on balance, it's a good thing to have. The Fed is literally guiding short-term money markets, sets the price of credit, and then it buffers and ensures that in any given day it functions in an orderly fashion. That's not planning, nor is that a free market fantasy. That's market craft.
You think the government can decide which
and inspiring
but the Fed, I'm not talking about the Fed, but let's talk about just innovation in the way that, the way that the private sector decides to allocate resources for things. You don't think that's more effective than a bunch of smart people in Washington?
I wrote the book because I believe that the private sector is very, very important to spurring innovation.
No, that's what the whole book
needs to be managed and
it's about entrepreneurs more than
it's a dance. You need two. You need the state and you need markets to make it work.
But it was just that the government industrial policy has been more important than the private sector in terms of innovation.
I think this is a false choice. More important or less important. You need both of these things to guide markets and make sure that they're working the way that we want them to. You need it on climate policy. I think the Biden administration is a perfect example of between the beginning and the end. Let me just finish.
Okay.
Where climate investment doubled because of the
Right.
IRA, because we agreed, hey, climate's actually a big problem, guys,
don't
and we
agree.
need to attract
He doesn't
private
agree with
capital.
that.
We don't agree
He
with that.
doesn't agree
And
with
I
that.
think
Most people
I think
think
that's
that-
a prime example of what I'm talking about.
Well, we agree on some things and we disagree
Right,
on
okay.
others. But I think the important thing is seeing that market craft is a real history that we need to wrestle with and reckon with if we're going to be able to think about these things constructively in the future.
Well, I just want to go back to then the tariff piece, because I would argue the tariff piece is similar to the carrot piece or the CHIPS Act.
That's
It's
what I'm
just
saying.
one
And both
or the other.
sides use industrial policy, and it seems to be ineffective on both sides. I mean, the CHIPS Act they picked Intel as one. I mean, they do have fab plants, obviously, but they picked the biggest.
But this goes
loser
back
in
to the question
industry.
whether then you're very happy they're taking money away from Harvard. My point is this is
Not having
picking
to
and
take-
choosing
I'm-
thing
with-
is
no,
the problem.
I'm just saying, I'm saying with $37 trillion in debt, that we've had 30 times the amount of funding just in the last 20 years or whatever.
Right, and what
it
I've
is.
said, if you want to defund universities, we should have a debate about that. If you want to defund specific universities, we should have a different conversation about that, because that's where it gets more complicated.
But I think the key thing that I'm trying to say is that it's not just about industrial policy. You look back at Treasury Secretary Bill Simon, a libertarian's libertarian.
Right.
When he was in government in the 1970s, he worked with Alan Greenspan to set up the Strategic Petroleum Reserve to take enormous amounts of oil, store them here so that we would be able to be resilient if there was another oil embargo, and so that we could buffer the price. I don't think you would call that industrial
No.
policy. I wouldn't either, but it is market craft.
But
It's saying that
right.
we can't just wait for energy markets to supply us. We need government to have a guiding hand here to make sure these things are
Of course.
stable. And we haven't had
Then you're-
an energy crisis in 40 plus years because of it.
Then your guys, I'm talking about Biden, used it because the emergency was that prices were too high during the midterms. So we depleted it to where we're down how much at this point?
The SPR.
Yeah.
The SPR still has hundreds of billions
Right, but
of
we're
of
probably
gallons.
40%. Aren't we down 40%?
Well, the whole idea is to use it to buffer. Like if you're not using
No,
it,
you
then
said for wars. You didn't say for higher
no,
energy
I didn't say
prices,
for worse. No, actually for price buffering. I think it's important.
That wasn't an emergency, the midterms.
What I think is important to learn from the SPR is that we can buffer prices, right? So that when they get high, we can ensure that they don't get too
No,
expensive.
I like
and when
the
they go
I
low,
like
we
the
can
SPR.
ensure that they're exactly, and that is market craft.
It is fossil fuels, though, Chris.
Well, it is. We need them, it turns out.
It's a longer
For a little-
conversation.
for a little while longer.
The book
Till
is
next
called
year.
Market Crafters, and it's a fascinating history of just what's happened in this economy, and it actually creates a lot of this good debate. So, Chris, thank you.
Thank you for
Congratulations
having
on
me.
the book.
Coming up on Squawk Pod, Becky Quick is in Houston. With her, Goldman Sachs CEO David Solomon. He has a word of caution on the world's history of confidence in America's economy, and he, like everyone else, is awaiting tariff certainty.
I don't think that we're taking 80 years of a direction of travel and just reversing it instantaneously, but I do think these are serious things that you have to watch very, very carefully. And if we don't get to a policy place of certainty where people can trust and they can rely, it will have longer term implications.
Solomon's take on market health, U.S. Treasuries, and much more right after this. You're listening to Squawk Pod from CNBC with Joe Kernen, Andrew Ross Sorkin, and Becky Quick.
We are here at the Chevron Leadership Initiative's Co-Mission Champions of Women in Sport event. Joining us right now is Goldman Sachs CEO David Solomon. He's here because Goldman Sachs has an interest in women's sports and in the LPGA in particular. But David, I want to talk to you about what's happening in the markets right now. It's been a pretty confusing time. You're seeing all these weird things happening with equities dropping, bond yields going up, the dollar dropping pretty steadily, gold prices at all-time highs. And it's making people wonder what this all means. Is this a crisis of confidence in our markets right now? What do you read as to what we're seeing?
Well, first of all, thank you for having me, and it's good to be with you.
Thank you for joining us.
Absolutely, it's good
Yeah.
to be with you in Houston. We're in a very different macro environment than we were in just a few months ago. I think the last time I was on the show and the last time I spoke to you guys was in Davos, and certainly we could all talk about kind of the aura of how people felt in Davos, but it was very, very different. You were coming into the inauguration. There was a lot of optimism around a lower regulatory environment and changes. And so now we're a few months into the administration, and instead of policy becoming more certain, we actually have a greater sense of uncertainty broadly, and it's having a big impact on asset prices and markets. And so the trade policy and the discussions about trade policy certainly have changed the level of uncertainty in markets. Markets are looking to reprice the value of things based on the uncertainty they have around what these policies will ultimately look like and how they will ultimately be implemented. And that is therefore causing shifts in fund flows on a very significant basis. And I think one of the things that's different about what we're seeing right now is normally when asset prices, when equities reprice, it's not surprising when you go into a more uncertain environment that equities reprice. But generally when they do, people buy US Treasuries. But here we're seeing different behavior because at the margin, people that have been very, very inclined towards US dollar assets are slightly shifting their preferences. And I'd say it's still at the margin, but as people are selling equities, that puts downward pressure on the dollar, given these are all US equities. You've got investors around the world buying US equities. And as they de-risk to some degree, that's putting pressure on the dollar, and that obviously has an impact on treasuries. So the level of uncertainty is high. I think it's good that there's been a delay, let's say, in the implementation of these reciprocal tariffs, but we still don't know what these deals are going to look like, where it's going to land, and what the ultimate impact on business will be. And so what's happening is business is pulling back. People are pulling back because they want to wait and see. They want a higher level of certainty before they make decisions and they move forward.
So you think this delay is good? You think it's good because it gives it a chance for them to undo some of those actions and activities?
I would say the delay is good because this was all happening very, very quickly. And I think these are complicated issues, and we need more time to see what the ultimate result will be. I think one of the things about the delay is the delay didn't decrease the level of uncertainty. In fact, in some ways, the delay increased the level of uncertainty. And so until businesses and individuals all over the world, not just here in the United States, can understand our trade policy, how it's going to be implemented, and that allows people to step back and make decisions about their capital spending, their investment, their planning. We can understand relationships in global markets with respect to the dollar. Until we settle down and get to a place that can understand that, we're going to see a higher level of volatility and continued pressure on U.S. asset prices.
So you say this is around the margins, just in terms of investors having less faith in the United States and other places. Do you think that this, because some people get hyperbolic about this and think that this is the end of the American exceptionalism when it comes to the markets. Do you think that's the case?
Well, I've been talking to clients all over the world, and I happened to be on a trip, overseas last week. I was in the Middle East a little bit last week, and the reason I say at the margin is kind of U.S. preeminence from an investment perspective and the long-term flow of international investors into U.S. assets because of the relative performance of the U.S. is something that's happened over a very long period of time. And you can't reverse it 100% in 5 minutes. And so what we're seeing is certain changes in behavior at the margin. But when you step back and you ask, what are the opportunities? Where can you go? Think about it as a balance in a portfolio. If you've got more U.S. dollar exposure, there are two ways that your portfolio rebalances and you have less U.S. dollar exposure. Right. One of them is you can sell the assets. The other is the relationship between, let's say you're a European investor, the relationship between the dollar and the euro changes. So I don't think that we're taking 80 years of a direction of travel and just reversing it instantaneously, but I do think these are serious things that you have to watch very, very carefully. And if we don't get to a policy place of certainty where people can trust and they can rely, it will have longer term implications.
But I guess what is the alternative? Where people go?
Well, that's one of the things as I listen to clients and I talk to clients that are big capital allocators around the world. And we happened to have a conference in the Middle East last week where we had both capital allocators from that region, but also a bunch of U.S. capital allocators come together. And when you step back and you look at the big buckets, the big opportunity buckets, whether it's the U.S., whether it's broadly across Europe, whether it's China, still, even with all the issues that we're facing here, when you look at the innovation economy in the U.S., you look at what we're capable of from that perspective, you look at our capital markets, our capital formation, our financial system, we have enormous embedded advantages that I think investors around the world recognize, but they're concerned by the level of uncertainty. They're concerned by the pace of change. And they're looking for more clarity as to how this will settle down.
And the tariffs in themselves, where do you think things will settle down? If markets are reacting and trying to reprice to whatever that ultimate place is going to be, what do you think ultimately happens with tariffs?
Well, I'm watching as you're watching. I think the administration has been clear they want a base level of tariffs to stay in place. But I think it would be very helpful. My understanding is there are a number of discussions going on with various nations. It would be good to see a deal or two put forward so there's a construct that people can understand and people can start to say, okay, if that's what these deals are going to look like, this is a framework that we can start to think about and we can start to plan as we look forward.
If you had framework like that was put out with some of these deals, where are the equities markets priced to those deals? Would there be relief in the equity markets at this point? Would it?
I'm not a good speculator as to ups and downs in equity markets, but the one thing I know for sure, if you can create a roadmap and a clear understanding as to where we're going and what the desired result is, confidence, will improve. Will improve equity market prices.
David.
And markets tend to overreact in the short term. We've all been through, stress. In markets, they overreact, but you get to a different place when you look forward 6, 12, 18 months. You get to a different place where the market has digested that change in the macro environment. It will be no different here.
David, Joe has a question as well. Joe?
Sure.
Dave, I just wonder, in terms of tariffs, we're told that they're inflationary and they could be recessionary. I mean, it's like the worst of both worlds, theoretically. Now, we don't know the uncertainty of the 90 days. You point that out. But if we don't see them totally implemented on the inflation side, isn't it more likely that the real risk is that it's going to be a growth problem and that we're going to see a slowing of growth, and therefore maybe the Fed can you make the case the Fed should preemptively start easing? Are they easing enough by lessening the tightening, or do you think they should actually cut sooner rather than later?
Well, Joe, you're raising the right point. I wouldn't say that the tariffs are recessionary, but there's no question the trade policy that's been articulated, or the direction of travel, has changed the perspective on forward growth. So consensus on forward growth was 2%. It's obviously much lower now. Mm-hmm. I don't know whether at the moment we're growing 1%, 0.5, 0, but growth has slowed. And part of this is it's a little bit of a self-fulfilling cycle. If confidence comes down, people obviously pull in, and that slows spending, that slows investment, and it slows growth. And so, certainly there's inflationary pressure to the degree tariffs are put in place. We're now in an environment with slower growth. Those are kind of contradictory forces that ultimately the Fed will have to deal with. The market at the moment is telling you, given the actions that have been taken, that they expect the Fed to cut during the course of the year. And to the degree that the economy really is slowing down, I do think ultimately there's a good chance you'll see the Fed, wrestle with that and try to create some sort of support for that slowing economy. But if you have inflationary pressure, that makes their job much more difficult.
Do we, though? I don't know if we do. That's my. I think one risk is much higher than the other. And as crazy as President Trump seems at times, I fear that you're going to look back and say, he was right again. That probably Powell should have cut earlier.
Well, I think we're gonna see. We have very little data. I woke up this morning, was watching the show. You have a handful of companies, reporting earnings. At the moment, everybody's reporting earnings from the first quarter. You look at our earnings in the first quarter; it was reflective of an environment. We're now in a different environment, and so, Joe, until you have more data and more information, it's hard to. And this is one of the things I think about the Fed. The Fed is very data dependent. Until you have more data and more information, it's hard to understand exactly where this will go.
Right.
Hey, David, Andrew, I'll get 1 second, just one follow-up real quickly. What you're saying, we're in a different environment right now. What have you seen the last couple of weeks, just in terms of the activity you've seen from your clients, the potential for deals out there? What is that telling you? Describe this new environment we're in.
Sure. I think there's a high level of uncertainty. There's no question that capital markets activity is slower, but it's not zero. The first quarter was a reasonable quarter for capital markets and M&A. As we enter the second quarter, it's slower. We're early in the quarter, but it's not zero. We were involved in a significant deal, for WorldPay and FIS last week. It was a very significant deal. That deal moved forward. I think we're involved in a deal for Versace, which was, another deal. So there's activity. But to the degree that the uncertainty increases from here, there's no question that will slow down, that deal flow and that capital markets activity more. To the degree that we start to see some trade deals and we start to see a roadmap to the direction of travel, there's a lot of pent-up capital markets activity, and I think that will come forward. And so, again, you need, everybody wants to jump to the conclusion. I understand why people want to jump to the conclusion, but it's hard to jump to the conclusion based on where we are at this moment.
Andrew?
David, I want you to put your investment banker hat on. Be the advisor for a moment. So I'm President Trump. I'm hiring you, David, and Goldman Sachs. I'm hiring both of you collectively to advise me on how to negotiate this deal, right? This is what you guys get hired to do constantly by CEOs who want your advice and want to understand where the leverage points are in these negotiations, how to best negotiate these tariffs. Do you do them ad hoc, one at a time? Do you try to do some collectively? The reason I ask is because I think there is a major leverage question, which is to say that if you try to actually knock off a couple of deals early, those early countries actually oddly have leverage over you, which is to say that you're going to probably give them maybe better terms then. But then it actually makes it harder over time because everybody knows that that there's going to be like a favored nation status situation going on, and nobody else is going to come to the table in the same way. The other question is, to the extent that the ultimate goal is to be able to have real leverage over China, you need a lot of these countries to get together with you. And so if you're Mark Carney, it's not clear to me from a leverage perspective that he sits around and says, how much can I give you, dear President Trump? It may be, how much can you give me if you want me to help you with China?
Was that a question, Andrew?
I want to know what you would do, how you would go about all this, given what you understand about negotiating and leverage.
So, Andrew, as you know, I was an investment banker. I'm not a trade negotiator, but I do think these are relationships. They have different contexts. The relationships between different nations are different. These have to be negotiated one at a time. But I think the important thing is to set out a roadmap of priorities. What are we trying to accomplish? What are we trying to get done? And then this is going to take time. You're going to have to, each trade deal, if you're negotiating with all these different nations, each trade deal is a one-off negotiation ultimately, and that's going to take quite a bit of time to execute on.
David, let me ask you about the markets right now, just the plumbing, because it felt like a couple of weeks ago we were getting to a point where there were some real concerns being raised, just the bond market in particular, the way it was reacting, and people can look and say, okay, that was some hedge funds that were settling some trades that had to sell some of their most liquid assets. Do you see any problems in the plumbing?
The plumbing. I mean, this is something that the bank CEOs have been talking about. Certainly, have been in touch with the Fed. I've been in touch with regulators, et cetera. The plumbing has been, markets are working quite well. Now, people don't like when stocks go down, but markets have been working quite well. I think the change in exposure that came down in March when people de-risked a little bit, I think helped as we came into this. One of the things that's just interesting to me, there's been a move in credit spreads, at this point from what I'd say was kind of all-time tights. But we're still, if you look at, high yield credit spreads yesterday, they're still tighter than kind of, 10-year averages. And so credit spreads have held in nicely. That's something to watch if the economy does indeed slow. But at the moment, markets are functioning, very, very smoothly. I do think you want to watch, the Treasury market, and that's not because of the functioning of it. That's because of the fact that we need to finance, our debt deficit. And so, obviously pressure on that has broader implications in the context of how we finance our debt and deficit, but that's not the plumbing and the efficiency of markets at this point. This is a stressful time, but in terms of market function, this is in no way a crisis.
What do you think in terms of the Trump administration? You talked about in Davos how everybody was coming into this thinking this was going to be a much more business-friendly administration. It hasn't worked out exactly the way a lot of people have planned on this, but is this a more business-friendly administration? What's your relationship?
Well, the question, you ask the question and it obviously immediately gets to a comparison.
Right.
And so the expectation was, because the last administration was very, very difficult for business, very, very difficult to engage and to communicate broadly across, all industries. The expectation was that this would be improved. I think one of the things, and I've said this publicly a number of times, the administration and people across the administration are engaged with the business community. That's constructive. There are certain things that have been put forward from a policy perspective that that don't feel in line with the expectation people had. But obviously, we'll have to watch and see how the policy is implemented. Watch and see how some of the stuff with the FTC plays out. Yeah. But it's early days, and certainly it's hard to know exactly where that lands. I don't really think about administrations as being business friendly or not business friendly. Ultimately, the economy, growth, and investment needs interaction between government and business. It's very, very important for economic growth, broadly. And so, hopefully that'll continue to be very constructive.
Joe?
Yeah, David, I just trying to figure out how to phrase this, because I certainly don't want to be Pollyannish or cheerlead anyone who's close to retirement. This is gut-wrenching, obviously, when you have close to a bear market in some of the major averages, and actually do have one in some of them. But is there, in your view, is there a half-full way to view any of this? I mean, the market, would you say this? I mean, 7 stocks led that market up 20% 2 straight years to highs. I don't know whether any of this was destined to happen anyway. We need corrections occasionally. Is any of it cathartic? And if we do, maybe not go scorched earth on tariffs, but if we go selectively and get some deals done, is it possible we're in a good place a year from now? Because there's so much pessimism now. People are writing off the next 4 years before that we're done with the first 100 days in terms of the economic record. Are you optimistic at all?
Well, I'm definitely optimistic when you step back and you take a broader view, Joe, because I continue to have enormous confidence in the U.S., the innovation in our economy, the forward on technology. When I look at what's going on with AI and the ability to deploy it in the enterprise and create massive productivity, across business broadly, massive productivity in our economy. When I look at the impacts that it can have around healthcare and health and wellness, these benefits, these are things to be enormously excited about. And so we had an extraordinary equity market, and as you point out, 7 stocks led the way. It's not surprising that something has rebalanced that. I did not necessarily expect it to be this in the form that it is, but certainly, and we did talk about this when we were in Davos, we talked about the robustness of the equity markets. And, it's interesting to go back and kind of look at a basket of stocks and where they were 12 months ago. Obviously, the Magnificent Seven and that NASDAQ-led rally has certainly, had a dramatic move. Right. But at the same point, there are lots of companies and stocks are up, versus where they were.
Goldman Sachs is up about 85% from a year ago.
A year ago. So, all this has to be put in perspective. Right. I think the level of uncertainty is too high. Okay, it's not productive, and it's important that we have a clear understanding of the direction of travel as soon as we can, so that businesses can plan, make investments, continue to help drive our economy forward. And
have
also,
you heard
so
any
people can have
CEOs,
confidence.
David, say? I mean, this is what we're hearing, that they had the rug pulled out from under them, and I mean, I think it's implied they'd actually go back if they voted for Trump and want to change their vote to Kamala Harris. Do you know any CEOs that say they miss the Biden administration in terms of their approach to business?
I think, Joe, what I'm hearing from CEOs, from clients that I'm talking to, is they want to understand, they want to have more certainty with respect to what the policy is going to look like, where it's going to land, what deals are going to look like, so they understand the lay of the road, the lay of the land, and they can make adjustments if necessary in the way they run their businesses. You can't change these things. When you look at supply chains, when you look at where things are made, when you look at how these supply chains work, you can't change them in 5 minutes or 5 months.
There was a question in there,
these
David. You asked Andrew if there actually was a question in there, but you didn't answer the question. Do you know, are there a lot of CEOs saying, God, I sure wish I voted for Kamala, or I wish it was the Biden administration policies on business? Are we there yet? I don't think we're there
Joe,
yet.
When I'm talking to CEOs, we're talking about policy, we're talking about investment, we're not talking about people's election preferences.
All right. You're not just worried about saying the wrong thing and incurring the wrath of President Trump at this point, are you, David?
No, I think I've been clear. We need a higher level of policy uncertainty. This level of uncertainty is not good. It's not healthy, and it's affecting investment, spending, and planning, and that will have an effect on growth in the economy. And we will see that, in my opinion, relatively quickly if we can't get to a higher level of certainty around this trade policy.
David, let me ask you about why you're here. Goldman Sachs' interest in women's sports, in the LPGA in particular.
Well, we've had a relationship with Nelly Korda for a number of years, and I just must say, besides being an extraordinary golfer, she's an extraordinary human being.
She won this tournament last year.
She won the tournament last year, and she was honored last night at a dinner, as they do every year. And so we were both there for that. But there's an event this morning. I think women's sports is fascinating. Look, I come to it first from a personal perspective that I have two daughters. And I watch them and the impact sports had, on them and their personal development and their growth. But I also look at some of the superstars we have developing in women's sports, Nelly being one, Caitlin Clark being another. There's a lot of opportunity for growth and, interesting economics, in women's sports.
That's what I want to get to, the business proposition for this.
Well, the business proposition is very, very strong, and it's moving. If you look at the WNBA media rights deal, if you look at the
what was that, $100 million over the course of 6 years, I think, that was for Unrivaled.
Yeah,
that was for Unrivaled, $2.2 billion.
$2.2 billion. If you look at the salary cap structure in the WNBA, it's going to get a big move with this media rights deal. Now, obviously, these brands, these franchises, they're not, 50, 100 years old, and they're still developing, but they're attracting more attention. I think the direction of travel is certainly, pretty obvious with respect to that. You're seeing more and more investors taking a look and saying, hey, look at the relative value equation here. Look at the direction of travel. Look at the way the expansion of media rights can impact this. There's a good opportunity here around a variety of sports to get involved. And so we've got, a number of clients that are looking at women's sports in a completely different way than they did just 2-3 years ago.
All right. David Solomon. David, thank you very much for spending time with us this morning.
My pleasure. Thank you for having me always. I always like being with you, Andrew, and Joe, and appreciate the opportunity to be here with you, Becky.
You've got an open seat anytime. Come join us at the NASDAQ.
I appreciate it. Thank you.
That's the podcast for today. Thank you for tuning in. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin every weekday morning on CNBC starting at 6 Eastern. To get the smartest takes and analysis from that 3-hour TV show right into your ears, follow Squawk Pod wherever you're listening now. We'll meet you right back here tomorrow. Have a great day.
We are clear. Thanks, guys.